All right, really excited about this one. December 2021 market update. We've seen the market move around quite a bit, and so I've been really excited to really take a look and see exactly what's happened over the last month. I want to make sure I disclose that this information we're looking at is as of December 2nd, 2021. It's currently December 24, 2021. So the market has moved around a bit since the second, but honestly not much. Right now, what's really popular in the media anyway is the talk of inflation. We've also seen unemployment come down, I think, to not historic lows, but it's come down pretty far. There's a lot of talk of supply chain constraints, things of that nature. I don't know how much of that is really what's driving the market right now. There's the new Omicron variant, whatever that means. So there's talks of new restrictions and new lockdowns and things of that nature. I don't know what travel looks like. I haven't looked into that, but that's kind of what's going on. And so it has kind of rocked the markets a little bit. We are looking forward to seeing some sort of rate hike in the very near future. So all of that stuff is really kind of what's happening right now in the market. So let's take a quick look at our sectors and make sure I got everything here. Okay, so this is the basic material sector. And again, I want to reiterate too. I know I've said it before, but I'll say it again. All of the companies that we're looking at, which is about 140 or so companies, are the largest companies that are headquartered in the United States. The stock price is under $150. They're paying a dividend of more than 2%, and they've paid the dividend consistently for at least 10 years. These companies have also all been in business more than 10 years. Okay, so that's what we're looking at. And so the basic material structure is, basic material sector is exactly what it sounds like. You know, this is all of the materials that are used to build things and make things. And so we see right away that CF is the leading return for the sector over the last 12 months. And again, you know, what's really fun for me is that even though we're in the mid part of our fiscal year, we are at the end of the calendar year. And so we'll be looking at everything from from January 21 to now December 21. And so CF had this really big jump up in October, which I'm pretty sure is what's driving a bit of that average return. We see IFF, which I don't know a lot about, comes in second, and then we are in Southern Copper, which has an actual average of 0, meaning that it has not moved around at all over the last 12 months. AEM, which is the sector MVP, has the worst return for the sector. And so I think that's telling. I'm not sure quite where AEM lies. We'll figure that out here in a moment. But somehow it's been on the best performing portfolio 7 times over the last 12 months, and it is the worst performing in the sector. Meanwhile, Southern Copper, where we are, has been on the best performing portfolio 5 times. And we can see it's pretty much the same other than CF, which had this big jump back in October. But you see, you know, negative returns, then positive, and then negative again. And again, it looks like CF is going the exact opposite of the rest of the sector, where they had a loss in November and everyone else had a gain. So something interesting to look at. This is a new metric for us, something I'm really excited about. I don't think this is really going to give us any real information for at least a couple years, so that we have a nice population of data to kind of go back to and look at. But as of right now, 44% of the total basket of stocks that we have are above their 200-day moving average, only 12% above their 50. That has come down a bit over the last couple months. And then we see the sector as a whole down in October, jumped back up in November, and up slightly in December. So what that's telling us is that the basic sector as a whole is climbing up a little bit here. 14% over the 200-day. I want to make sure I'm looking at that right. CX. Yeah. Okay. Yeah. So 14% above their 200-day. Which is 67% worse than the rest of the market. Zero are above their 50-day, and we can see that here. All of these companies in the basic material sector are below their 50-day moving average, which is, the worst performing out of the entire market. Now, why is that? I think, and we'll see this maybe here in a moment, is that I think a lot of the money, a lot of the investment is going into cyclical type companies, growth companies. And so something like basic materials that has to do with, the very boring, mundane, like I said, just, concrete, wood, chemicals, things of that nature, metals, it's not a growth stock, right? It's not something that's going to make a huge amount of money. They kind of just do their thing, right? Of course, with the exception of CF, which is interesting. But that's kind of just where we are. So let's go down now to next sector. Let's see, communication services. Always interesting. I don't know exactly where this sector is going to go. At some point, I think it's going to either be part of some larger sector, or I think it's going to change. But for right now, it's kind of where we are as far as the phone companies and whatnot. So as you can see, the MVP is pretty spread out. It looks like everyone except for Rogers, where we are now, has been part of a best performing portfolio over the last 12 months. Tullis and British Columbia are the best performing in the sector, which is interesting because they are the Canadian telecoms, which is where we like to be. We've been in Rogers Communications for quite some time. The price just has not moved around enough to warrant us to sell or even purchase more. I would love to purchase more, but the price just hasn't moved around enough for us to do that. It isn't the worst performing, just slightly under 0% for the last 12 months, meaning that the price has not moved around much at all. AT&T, as you can see, for the last 12 months, is averaging a minus 2% a month. And so that's important to understand too. So these averages that we're looking at is the average return for the month, meaning that we can predict that next month, roughly 65% probability that AT&T is going to return negative 2%. All right, that's what that means. Same thing with TELUS and BCE. We can predict that there's a 60% chance that these companies are going to return roughly 1 to 2% for the month. And so that's what that means. Kind of following along with the basic sector, we see that most of the companies in the communications had a decline in October, and then had an increase in November, with the exception of AT&T. And then we see another decline in December, and it looks like AT&T has performed the worst over this last month, from November going into December. So let's take a quick look now at the overall sector, looks like 40% is above their 200-day. None of them are above their 50-day. So right now, it looks like historically they're doing better than basic materials. But recently, I think everyone is probably just down as far as the market goes. There are a couple companies, though, looks like right at their 50-day moving average. So they're not far below. They're not far below. And it looks like that is, yeah, BCE and Telus, of course, which makes sense. They're the better performing companies out the bunch. Sector itself looks like it was dragged down by AT&T in December, but for the most part, it's been slowly increasing over the last 3 months until just this past month. And like I said, I'm pretty sure AT&T has a lot to do with that. And again, 40% above is 200. It's not great, but when you look at the fact that it's only 9% less than the rest of the basket of stocks, that means that telecoms um, are not the worst performing sector at all. Kind of just moseying along, I guess. I'm pretty sure everyone's going to be somewhere around zero for the 50-day. Let's see if I can get all of these. Yeah, I can get almost all of them in here. All right. So, IPG sector NVP. Let's see. There we go. No, Best Buy is a sector NVP. Looks like the average return, it's not great. General Parts Company. This is auto parts. Looks like they are, no, IPG is. Okay. Well, a second. We'll call it a second place. IPG is doing the best as of right now. And again, it looks like everyone was pretty much down with the exception of IPG for October. And then maybe about half, if not more than half, were up for uh, November and then down again in December. I think it's important to note here that Best Buy took a huge hit in October, kind of recovered in November, and then lost everything again in December. I think that says a lot about the company and where it is. This is retail, talking about supply constraints. We talk about inflation. We're talking about um, people's spending habits, right? What I think is interesting is that yes, inflation is here, right? There's no doubt about it. But the reason why inflation is here is because there was so much free money floating around from COVID and the printing of these dollars. We do know from the last earnings report from Regions Financial that U.S. savings accounts were up. So people have more money to spend. So inflation is not that big of a deal as long as growth and wages can keep up with it. That's the trick. And so, um, we've talked a little bit about growth, um, um, whether or not wages are keeping up. We don't know. We'll have to look at the reports and see where that is. I did hear from a few people that wages were actually cut due to the pandemic, and now I think some of those wages are being paid back. So we'll have to see. I think Christmas is going to be really the tell all. I do not think the numbers will be as good as expected, but again, we'll have to just wait and see what happens. Some of these retailers, I think, are can easily raise their prices to keep up with inflation, and then some can't, right? Usually around holiday times like this, companies like Best Buy will usually offer discounts and things of that nature to drive sales and to drive profit. I don't know if that strategy is going to work, or even if they're doing it. My game plan is to try to get in and snap up some sales after Christmas from Best Buy myself. So we'll see what happens there. International Papers is where we are currently. They are negative right now, down 11, down 7, and down 6. I mean, just a negative trend over the last 3 months anyway. Um, and the better performing company, IPG, of course, still down. And so again, I think that says a lot about kind of where we are right now, uh, as a whole in the market. So 38% over their 200-day, which is 14% worse than the rest of the market. So that means that the cyclical companies are performing worse than telecoms, and that is very telling. Typically, cyclical companies are these growth names, right? These high-powered, high profits, large margin companies that's really killing it, and that's just not happening right now. It's not happening right now, and that goes to show where investors' money is going, right? That goes to show where's people confidence is at. And right now, it doesn't look like it's in those cyclical retail plays. International Paper, it kind of goes right into that because they do a lot of the cardboard boxes and stuff like that for shipping. So we're talking about Amazon, we're talking about Amazon predominantly, but eBay and all these companies that ship products through the mail are using these cardboard boxes, and of course they go to International Paper. They're the largest cardboard manufacturer in the U.S. They also have plants over in China and one in Russia. So anyway, they're just not doing the best right now, and we do have a buy signal for International Paper. So I will do an analysis and just see, kind of where the price is supposed to be compared to where it is and where we think it can go. Again, none of the companies are above their 50-day. And so everything is kind of down. And just looking at the sector as a whole, we see negative, barely positive, and another negative in December. So cyclicals is not where it's at currently. Let's get down to defensive. Now, I expect the defensive sector to perform better because these are the companies that we can't live without. They're going to make money no matter what. And we have quite a few of these companies in our basket of stocks this year. So it's going to be hard for me to show all of these. But I do want to show we are in Campbell's soup right now. There is a negative trend monthly, as you can see, negative 1.5. Not the sector MVP, but it has been on the best performing portfolios at least 3 times over the last 12 months. Philip Morris, cigarette maker, has a positive return. And 2, SYY, I always forget what that is. I want to say that's Reynolds Wrap or something like that, but it looks to be the sector MVP. Yeah, it's the sector in MVP, still with a negative return though. Walgreens is WBA. They've performed fairly well through all of this. BG is actually the best performing company at 3% a month, which is bananas. And yeah, this is really a mixed bag for consumer defensive. In October, we expect to see some minuses, but we have quite a few pluses in here. And then November, same thing. It really, so far, it looks like if you were down in October, you were up in November. If you were up in November, if you were up in October, you were down in November. And then kind of same thing in December. If you were down in October, you were down in December too. So I think that says something about the market, right? So we see KO here, which I believe is is Coca-Cola. Down, up, down. Procter and Gamble, down, up, up. And then we got Kroger, which is up, down, sort of down. So I don't know. It's maybe it's a situation where Coca-Cola is looking at inflation. Kroger, maybe not so much. Um, let's see Clorox. Yeah, they're looking at inflation. GIS, I don't know much about them, but they've been killing it the last 3 months. Kimberly Clark, it's diapers. Yeah, they're dealing with inflation. Um, but they actually beat out in December. That's interesting. Yeah, it's really hard to pin down. So let's look at the sector as a whole. I'm really curious about this. Let me just go up. There we go. All right. So 28% above their 200, which is, yeah, not great. So it looks like telecommunications is kind of where it's at. I want to take a look real quick at, because I forget. So basics was 14%. So yeah, so telecommunications so far is is really performing the best, which is one of those like utility type things where we pretty much know where their money is coming from. We pretty much know how much they're going to make. There's not a lot of surprises. None of these companies are above their 50-day. And again, it just says kind of where we are in the market, right? Like everything is just down compared to the last couple months. And as you can see here, positive, negative, just hasn't done very well at all. All right, let's take a look now at energy. Let's see how many we have in energy. Quite a few. And the reason why is because energy typically has a larger dividend. So when we start grabbing these companies based on our criteria, we will usually get more energy companies than anything, just because their dividends are usually higher. All right, so it looks like Valero, where we are now, is the sector MVP, but definitely not the best performing, even though it's the better performing of all the companies that we're currently in at the moment. Looks like the sector average is about 4%. Let's do a quick average here. Let's see. Well, we got some that's down. Um, well, so the average is actually about 3%. So Valero is not far away from the sector average, but compared to these other guys, you're looking at 6% and 5% and 4%. It's like, man. Um, so October, everything, look like everything is up double digits. November, looks like you were either up double digits or single digits, and then December, everything came crashing down. And so the question is, what happened in December um, that caused this? And I can't think of anything. And I'm sorry. Let's talk. So when I say December, what I really mean is November 2nd to December 2nd. So this is really November, right? So what happened in November that caused this? And I think it had a lot to do with the news that the U.S. was going to release more oil, but I also think it has a lot to do with this whole Omicron variant, right? And the idea that we may be looking at lockdowns again. So what we can expect is that if in fact, and again, this is just media, right? This is just media. This is what people hear, right? If we hear that, things aren't going to be locked down, that, everything is going to be okay, then we can expect the energy sector to see some big gains um, next week, actually, because we're going to do this again January 2nd. Um, Chevron looks like it's performed the best out of everyone, even though it didn't have these big double-digit gains. They only had single digits, but didn't lose anything in December either. So I think that's telling as well. Um, and Valero is kind of in the same place, but for whatever reason, Valero is just a much more volatile stock than Chevron is, and I think that has a lot to do with oil. And you'd expect the same thing out of ExxonMobil and Chevron, but not the same company, obviously. We see Exxon double digits, single digits, and then lost big with everyone else in December. So let's take a look now at the sector as a whole. And wow. So yeah, wow. With all those double digit gains in October, sector really didn't move around much at all. Um, and then we see big gains in November, and then of course we see some losses in December. So 56% of the companies are above their 200-day, which is 28% better than the rest of the market. So energy is definitely a winner right now. 6% are actually above their 50-day, and so that's great. And so we will probably see this number come up as all of this news gets digested with, kind of where we're going globally as well as here in the States going into 2022. I do expect energy to pick back up, being that it has obviously worked at least over the last month or so. All right. Take a look now at the financials, the banks, something I'm really interested in. Um, and a lot of this is because of we have a lot of banks here. Again, same thing, just because of the dividend, right? There's a lot of great companies been around for a long time, paying a decent dividend. And so we have a bunch to look at in the sector. I'm trying to find the sector MVP. It's like, wow, it's really spread out. So two, three, two, yeah, it's just really spread. So every month, basically, it's possible that we're going to have a different um, company that's part of the um, better performing portfolio. All right, so see, Blackstone, we can call Blackstone the sector MVP. Not only have they been on the best performing portfolio 3 times in the last 12 months, but they are the sector leading um, gainer at almost 8%, which is crazy. And we see this huge jump in November, and then again a gain in December. Looking at not Rogers, Regis Financial, where we are now, roughly 3%, which is, I would say, probably close to the sector average. So I feel good about that. 3.5, 3. And the reason why this is interesting to me is because, again, we're um, talking about interest rates, right? And so typically banks and also insurance companies tend to make more money when interest rates rise, if they are able to get the business. And that's what's important here, right? Because they can charge more interest for those loans, but that's only if they can sell those loans. And that goes back to growth, right? So if the economy is doing well and people are able to afford loans, then they will purchase those loans and pay more interest on those loans as interest rates rise. All right, so let's take a quick look at the sector itself. All right, so yeah, 60, I'm gonna go up, 61% above their 200-day, which is really good, 15% above their 50, which is awesome. Um, Meaning that as of right now, energy and financials, best performing sectors in the market, as of right now, followed by telecommunications. Really curious to see what happens with utilities uh, down at the end. But um, December again, the market really just took a crap the month of November, and that's why you see this drop here. But again, 61% above their 50, 15% above. I'm sorry, 61% above their 200, 15% above their 50 means that this sector itself is doing really well. All right, let's see. I think healthcare is next. Healthcare has been a struggle for us over the last 6 years, and I don't know what to do. I don't know what to do, but we have to be in the sector trying to find a winner, and it's been tough. There's been lots of talk about vaccines and all this kind of stuff. All these healthcare companies, biomedical companies, are trying to get in and make money off this thing. Pfizer, which has had the best vaccine results thus far, is the sector leading gainer, and at 2.5%. Big jump, 21% month of November. Big jump, huge jump, which I'm pretty sure is what's driving this average. As far as MVPs, pretty much spread out, but yeah, well, I'll say it's spread out because there's only what, 5 companies, and there's 3 MVPs here, all tied at 4. Merck is where we are now, barely negative, but still negative for the year. CVS has, I think, been the best performer simply because it's not biomedical, um, um, it's not vaccine related. It is a store, it's a retail store, but it's in the healthcare sector. When everything gets locked down, CVS is still open and still going, and so that's why it's performed the best here. So let's take a look now at the sector. One second. Pets, man. Can't live with them, can't live without them. All right. So for the overall sector, so yeah, same thing. Positive trend, take a crap for December. Um, 40% above 200, but 20% above 50. My goodness, that's big. Um, so what this means to me is that historically, these companies are not doing better than what they have done before. But more recently, they have. And again, I think that it just goes back to the whole vaccine thing. Like, if you pick the winner, right, then you won. And so, again, we see that I'm going to say it's primarily Pfizer. And then CVS, I think, has just, consistently performed the best in this sector. But yeah, 20% above the 50 is awesome. Let's see where Pfizer is on its 250. So it's 6% above its 50. All right, there we go. So that's what's happening. And then it's such a small sector that one company being above its 50 takes the whole sector 20% above its 50, and then 23% above its 200. Um, so yeah, so Pfizer is really what has really done the job here. All right, so let's take a look now at our industrial sector. I don't expect much from this sector. I'm assuming it's going to be similar to basic materials. Let's see. So IRM, don't know a lot about that company, but they are definitely the sector leader. Paychecks, sector NVP, with IEP as a close second. We're currently in Raytheon, which has performed decent, not horrible. Paychecks is always good and has performed consistently, I think, over the years as a really great company. Has a lot to do with the growth of the economy, has a lot to do with unemployment, right? Right now, unemployment is down, and so Paychecks, which is a human resources payroll company, is going to perform, I think, better than the rest of the sector, because the rest of these guys are doing like Fastenals, doing like screws and things of that nature. Raytheon is rockets and planes and whatnot, whereas Paychecks is strictly employment. So let's take a look at the sector here. Um, Again, big drop in December, but fairly positive. 14% above is 50. It's not bad. Only 33% above the 200 though, which again just means that historically these companies are not doing great right now, but more recently they have, and it looks like there's really only one above is 50, and that is Fastenal, which is interesting. Um, so yeah, so again, still financials and energy, financials and energy. Let's take a look now. Real estate. Now, real estate is one of those sectors that can be close to something like a utility. Difference being, though, is a lot of real estate companies are sensitive to interest rates because they borrow a lot of money in order to purchase real estate and then sell it or lease it or what have you. Macerich, um, is an orphan stock that we currently own. One of the first, well, the first company that we purchased back in 2015. Sector leading gainer here at 5% a month, which is crazy. Um, SPG right behind them, CPT, you know, just and I do need to say that Macerich, they primarily deal in malls, and so I think there was a lot of talk because I followed this company quite a bit over the years because we were in the company for so long. We had just one share, so the price never moved enough for us to buy or sell, and that's the reason why it just became an orphan stock for us. But um, years ago, maybe 3, 4 years ago now, there was a lot of talk about malls becoming defunct and extinct. And I think now what has happened is a lot of the old malls that weren't seeing a lot of traffic, a lot of those malls have gone away. Some have found new life, turning into, other things, and some have just, gone away. But I think now, though, I think malls are in a good place. People are still going to malls, of course. I don't go to the mall often, but I do go to the mall, and I enjoy going to the mall. It is a place where you are sure to find more than a few things that you're looking for, right? Walmart is kind of that thing, but the mall is going to have something that Walmart just isn't going to have. And so I think malls are in a good place. The sector MVP, MPW is where we are. They are barely positive for the year. Looking at all the other companies in the sector, we're looking 2%, 1%. And then we get up into the threes and fours. EQR, same thing. This is going to be residential properties doing really well. And MPW, where we are, is medical hospital real estate. Um, not a bad position for us though at all, but compared to the rest of the sector, not performing great. But it is a sector in MVP, and so that is a good thing because that means that this company has been a part of the best performing portfolio. Like I said, most of the year, right? I mean, we're looking at 6 out of 12 months, compared to the rest of the sector. There's two, yeah, two, and two. So, yeah, I mean, it's pretty much spread out, but MPW has come in 6 times, and that means something, right? Let's take a look now at the rest of the sector here. All right, so same thing, took a crap in December. Barely positive, though, barely positive. Interestingly, and I did say this before we start, 62% is above their 200-day, 15 above their 50. So that's really, it means that, energy, financials, real estate, energies, financial, and real estate. And energy, of course, has the higher returns. Financials, not as great. So at this point, maybe we're saying energy, real estate, financials, right? And that's interesting, like I said, because of the interest rate environment that we're in. Usually, when interest rates rise, that is an issue for real estate because, like I said, they have to borrow at higher rates in order to continue business. But they've been doing well, and I think again that goes back to kind of where the money is going to, right? The money is coming away from those, high profit, high margin, growth stocks to more defensive. We know what you're doing, we know what to expect, type companies. Let's take a look at technology. Um, and technology also has been a story over the last month or so because of the supply shortages and things of that nature. Intel is the sector MVP, followed by IBM. But as you can see, the return has not been great. Hewlett Packard is where we were. They are the leading sector gainer, and you see this huge jump, 20% over the last month. That is because of the earnings call that they put out. I'm going to go over that here in a little bit, maybe. But yeah, 4% on average. That is a huge number. And so we'll definitely do an analysis to determine whether or not we need to buy back into the stock or if we need to go elsewhere. Take a look at the sector. Don't expect a lot from this. Yeah, just I'll tell you this. Probably has a lot to do with Hewlett Packard HP. But yeah, just barely negative for December compared to the rest of the market. 50% above their 200-day, 50% above their 50-day. Now that's huge. That is huge. So technology has really done a lot here. I mean, that is huge. 315% above the rest of the market. And so that's huge. That's huge. And so I think this goes back to, these technology companies, they are more of a consumer defensive company because, well, yeah, I mean, these days, I think it's safe to say that you can't do much without computers, without technology. And because of that, they are something of consumer defensive companies in that we're going to spend on that stuff no matter what. I mean, even if the economy took a big dip, you may hold on to your phone a little bit longer, but at some point, you're going to have to buy another phone, right? At some point, you're going to have to buy another computer. Companies are not going to go back to paper, right? That's not going to happen. And so I think the money is moving into these stocks as well. I think that the supply shortage has something to do with that. You know, talk about supply and demand. When supply drops, demand rises, and so does the price. With inflation, these computer companies, these technology companies can raise their prices, I think, pretty easily. You know, when you look at a company like Intel, who's the sector MVP by a fairly large margin, you can, I mean, Intel can pretty much name their price. You know, I mean, they can't go crazy, right? But they can pretty much name their price because you can't make a computer without them. You know, you can't make a lot of the things, a lot of the technologies that we use without a computer chip. And so, inflation, I don't think will harm them as much. Also, too, a lot of these technology companies, as we know, source a lot of material from overseas, meaning that U.S. inflation does not affect them as much because they're getting parts and labor a lot of times from other countries where inflation may not be as bad, but they're able to still charge more in the States because of inflation in the States. So I think technology will continue to work and improve as long as we don't see or hear any, you know, really bad news about um, the growth of the economy, GDP, and that sort of thing. So at this point, technology, energy, real estate. Technology, energy, real estate, top three. And now let's take a look at utilities, which I expected to really be near the top because, again, this is one of those consumer defensive type companies that, you know, they're going to make money no matter what. All right. Um, let's find the sector MVP here. Looks like ETR is a sector MVP. That's where we are. But it really is pretty spread out. It really is. See, FE is at 3%. I don't think anyone even came close to 3%. I mean, that is definitely an outlier. Everyone else is really pretty much at zero for the year, which is just really telling, I think. Utility companies themselves don't move around a lot anyway, okay? And so to say that month to month the price is going to be, you know, at zero kind of makes sense. You know, I don't expect to see huge jumps in stock performance from the utility sector. Um, with that being said, though, it is really interesting that FE is putting out 3% a month currently. Um, EIX had a big jump of 15% in November. I wonder what happened there. And then, like I said, we're in ETR currently. And same thing, lost money in October, up in November, lost money in December. I think that's the case pretty much for everyone. Um, even the outlier, same thing, loss, gain, loss. And so that just, you know, goes with the rest of the market. All right, so let's take a look at the sector. Uh, only 21% above their 200-day. I was not expecting that. 10% above the 50-day. So utilities are not doing great at all. Um, not well, almost, almost, almost horrible. Um, well, no, you can't say that because 10% are above their 50, which is the most recent performance metric. 21% above their 200, though, um, is not great. And so, you know, a utility company is the ultimate defensive play. but obviously money is not going there. Um, Money is flowing into technology, real estate, and I think energy is really just kind of volatile at the moment, which is why it's a winner, um, with financials kind of in the mix, right? It is interesting though. I think telecoms is performing better than utilities. Let's take a look here. So 9%. Yeah. So telecoms is performing a little better than utilities, historically, right? Historically. But most recently, utilities performing better than telecoms. And so I think what's happening here is that what is seen as a defensive play is changing a bit. I think that's what's happening. It is no longer strictly the, basic materials, utilities, um, real estate type of thing. It's now moving more towards technology, and I think the supply constraints has a lot to do with that because we're realizing now that because of the supply constraints, how important technology is, and that the sector is going to continue making money no matter what. Um, HP in their last earnings call talked about having a backlog, and they were confident that they were going to fulfill that backlog, meaning that the people who want to purchase computers but can't purchase them right now because there's no supply are going to purchase them once the supply comes back. And so um, that's kind of where we are. So energy is going to work depending on what happens with Omicron and lockdowns and everything. Technology is going to continue to work, has been working, and I think real estate is really the safe place right now because not only is it a traditional defensive play, but it seems to also work in this new defensive type environment that we find ourselves in. Cyclicals, however, not doing well at all. Um, but like a lot of people talk about dogs of the Dow, talk about bottom fishing and looking for value, right? Where you go into these companies and you get them really cheap, right? And then you sell them high when things come back. The question becomes, what will have to happen for a company like Hasbro, right? Um, to really come back. Best Buy, what would happen? What would have to happen for Best Buy to really come back? And I think the only way to really see these retail companies really do much better is that we're going to have some sort of complacency with inflation, meaning that it's no longer going to be the talk of the day, right? It's no longer going to be something that someone yells and screams about on social media. Inflation is going to have to be just a normal thing that no one is concerned about, right? We're just kind of going about our business. We have to see interest rates rising as a good thing, right? Because it is true that when interest rates rise, typically it means that the economy is doing so good that we have to bring it down a notch, right? We can get there for sure, but I think that has to happen before we can see these cyclical names really run like they have in the past. And as you can see here, I mean, GPC, as far as being a cyclical name in the sector, is pretty defensive because they're auto parts. You know, when you're purchasing brand new cars, right? There's not a demand for these auto parts to replace old parts in old cars. But when you have an economy kind of like, I'm not sure, then you'll have more people purchasing older cars or just holding on to cars longer that will at some point need replacement parts. IPG, I don't know anything about. I wish I could speak to it, but obviously they're performing the best in the sector. Same thing with MGA. I don't know a lot about it. Performing very well though. So that's that for the sectors. Let's take a look now at the portfolios. And I really like this heat map. Let me blow it up some more. Um, just because it is just a visual um, representation of kind of what's working and what has worked and what hasn't worked. Um, So we're looking at January 21 through December 21. Green, of course, being the better performing portfolios, and red being the worst. I'm going to see if I can freeze the top here. And I have a feeling that it may not work for me because I'm sure I've tried to do this before without much luck. So let's see. All right. So, again, this is just a visual, and I'm gonna actually go back here. See. So we see standard deviation is pretty yellow, meaning it's right in the middle, not moving around a whole lot. No dark reds, no dark greens. Um, I see some greens here. These are our beta plays. Dark reds, dark reds, dark reds, dark reds. Oh, here's some more greens. And again, these are our beta portfolios. Really red. This one is like really up and down. Um, dark green, dark red. All right. So yeah, I mean it's interesting. M score up, M score alpha, sort of interesting. But just looking at this thing visually, it really looks like the beta portfolios um, have really been a better deal just overall. And then we have something like, yeah, see, this beta alpha, beta up, beta down portfolio has some dark reds more recently, but nice green and light. Same thing with the standard deviation. We see the up moves, not bad. Down moves is the portfolio that we're currently following. But you see, um, in this down moves portfolio, we see these dark red spots here. Whereas next door to it in the up portfolio and even standard deviation, those portfolios didn't suffer the same fate. Even though, looks like everything fell in December, right? As far as the dark red goes. But, you know, these 2 months here are what's interesting because the other portfolios perform better those months. And we'll take a look at the numbers here in a moment. Um, let's see. All right. So this is most previous 3 months, previous uh, 3 months from there, and you can see the dates over here. So um, what we're looking for is just the last 3 months, the most recent, what has performed the best. And it looks like up moves is right about 6%. There's a lot of negatives here over the last 3 months. I do see some positives. So far, it looks like that 3% is the best performing. There's a 367 beta return alpha. So again, uh, beta portfolio again at the 3%. And I'm going to go back and look at the worst performing because I think that says something too. So let's go back and look at this again. So 3%, I think, is kind of what we're looking at. And so we see 3% in the beta return down. So again, we're talking about a beta portfolio, but it also has some return and down in there. Same thing here, 367 beta return alpha, 275 up in standard deviation. So far, it looks like, yeah, and then beta alpha. So far, it looks like the beta portfolios um, are really working. Oh no, here we go. 585. So the up move. So 585 definitely an outlier, performed better than all the other portfolios over the last 3 months. But if you look here, you see, I mean, down 5, up 11, down 4, right? So very volatile, very volatile. Which, they say hindsight is 2020, and this is why. Because if you're here, which is this is what, like September, I think, or something like that. Um, Maybe October, November, December. Yeah. So this is like October, and you're looking at this portfolio thinking, oh man, down 4%. You're looking at all the portfolios next to it, and you're just like, oh, well, that's just not that's not great, right? Um, and then you're up 11. You're like, wow, that's a huge jump, And you ask yourself, what can cause a portfolio, the entire portfolio, jump 11%? Well, it had to be just like one company that you know, just went crazy. Had to be, right? And then the next month you're down 5%. It feels like you haven't gone really anywhere. But looking at the numbers though, I mean, you can't deny it. 13% the 3 months prior, and then 2%. I don't think there's anything that's gonna come out better than that. Let's see, that's 21%. So we'll just say 20% from July to December, pretty much. Um, let's see if anything come close to that. Let's see, 15, 20. So yeah, 20%, and just a lot of negatives in here. I would say like 15. That's 10. Nothing close yet. A lot of negatives. 11, 14, 12. Yeah, nothing comes close. Nothing comes close. I mean, not even close. Um, the up portfolio has definitely, for sure, um, done the best most recently. And so this portfolio, I've talked about this before, but what it means is simply that, um, and this is talking about, I want to get the dates right. July 2020. Yeah. From July 2020 to June 2018. Yeah. So June 2018, July 2020, or something like that. Um, when there was a lot of volume, when there was a lot of buying and selling, um, these particular companies tended to move up more than any of the other companies in the basket of stocks. Okay. And so what that typically means is that if there's a lot of buying and selling, and really what we can say about that is when there's a lot of emotion, right? When there is this rush to do something in the market, right? Because you have times in the market where no one's really doing anything, and we see that it's called low volume, where there's just not a lot of trading going on. Everyone is kind of complacent. You own what you own. There's no reason to sell anything. There's no reason to buy anything. A lot of times that happens around holidays. A lot of times that happens in summertime, um, and so it's just low volume. So when you do have this push to do something, right? These companies, people tend to purchase. Um, does that mean that these companies are more defensive? Does that mean these companies are more, profit driven and high flying, big numbers? I don't know. I do want to take a look at it though. So that's the up moves. Blow this thing up. All right. And this one will be an easy one to find. Just at the beginning. Let's see what companies are in here. All right, here we go. So we got Best Buy, Blackstone, yep, MPW, Merck, Valero, Paychex, ETR, Intel, and AEM, and then AT&T, SYY. Okay, now what's interesting is we just went through this, right? Looking at the sectors, looking at the companies in these sectors, and I want to show you just real quick. So this is the current price. Okay, this is the purchase price, and this is as of I want to say July 2020. Maybe wrong about that, but I believe this is as of July 2020, and then this is the current price today. Okay, so this portfolio, and this is what's interesting about how these portfolios are graded. Okay, because nothing is bought or sold. Nothing is bought or sold. All these companies are purchased on the purchase date, and they're just held. And the portfolio is tracked over time to see how their portfolio has performed. All right. And so we see that the big winner here is Blackstone, which was purchased at 55, and the current price is now $130. That is almost 150% increase. And so I'm assuming that is what's driving most of this. MPW, a small increase. Merck, small decrease. Valero, uh, pretty big increase there. Paychex, pretty big increase. ETR, about the same. Intel fell a little bit. AEM fell a lot. AT&T fell a lot. SYY is up. And so when we contrast this portfolio with what we currently own, we're no longer in Best Buy, which I think is a good thing because Best Buy, as we saw, has not performed very well. Blackstone, we were in Blackstone a little while ago, no longer there. Um, I may go back and look at the video I did comparing Blackstone and some of these other companies. But I think for Blackstone, honestly, there may be an issue with the dividend. I'll have to go back and check. But either way, we're not in Blackstone. So MPW were there, Merck were there, Valero were there. Um, Paychecks were not there, even though, like I said, it's been a really great company. Um, ETR were there, and we're not in Intel. We're in Hewlett Packard, which is a better deal. AEM, we're not there, which again, like I said, is a better deal. We're in Southern Copper, which is performing way better than AEM. And then AT&T, we're not there, which again is good because Rogers is performing much better than AT&T. So where we're missing out is I think we're missing out on the Paychecks. We're missing out for sure on the Blackstone. No doubt about it. Let's take a look at the down moves, which is the portfolio that we're following. And I think I did this last month, but as you can see, We're not in a lot of these companies. NWL, IVZ, CAH, EOG. There's Macaric, International Paper, AEM again, PPL, Paychex again, AT&T again, IBM, which was second place for sector NVP. So, I mean, I think we're okay. It is interesting just to see kind of what is driving this up moves portfolio. And we do see the high flying cyclical Blackstone for sure. In the financials, we see the Valero, Paychex. So, I mean, there's a couple of these companies in here that we know are just not performing very well, but the rest we think are doing really good. And so, of course, that's why the moves portfolio is doing what it's doing. Let's take a look now at this historical 250 day. Again, we're not going to be able to get a whole lot out of this, but I think it is interesting to look at. 61% in October above 200, 68 in November, and now we're down to 45. And so that just means that, we're moving further and further down. That's the trend line, right? That's the trend line. We're moving down. And then I think the same thing for October, the 50-day, 35, 67, and now 13. I think that just means that we're moving around a lot. What I am interested in, because of this big up and down in the 50-day, is kind of what has changed the most, right? And so we see Southern Copper kind of where we are. It went from -6 to 0, down to -3, so it's kind of just right there, but it's trending up, right? CF trending down, even though it is best performing in the sector currently. AEM, we see the 50-day hasn't moved much at all. I mean, went from 7 to 0, back down to 10, so that's that declining. The AT&T definitely declining. Even on the 200-day, we see -5, -9, now -17. So it's just keeps going down. Let's see, Rogers is where we are, and we see -3, +1, and right back down there. So it hasn't moved around much at all. But just that variability from month to month is what we're seeing there. And then -5. -4, and now -7. So, -4, -7. Yeah, it's trending down, but it's still kind of right there. See, International Paper, -4 +1, -5, kind of just right there. -6, -13, -18, definitely trending down. So that definitely warrants an analysis. Let's take a look. Valero. So up, down, and then the 50 is up, and then down. So yeah, I can't really say. I mean, it's kind of right. Well, not really, because 2 and then up 7, and now down -2. And we also have a -4. So I would say it's trending down. So that's something to keep an eye on for sure. And then I'm interested in MPW because we're really close to selling out of that. Well, let's look at Regions Financial since we're here. So up 5, up 13, up 6. It hasn't moved around much at all. 2, 4, and then -2. So again, that's just that volatility that we've seen across the market. So what that means to me is that it's just moving with the market. Whenever you see something like that, right? Everything is pretty much up, down, up, or I should say up, up, down. You know, um, see, Merck, up, up, down, up, up, down. Yeah, just the rest of the market. See MPW. Here we go. So MPW, up, sort of down a little bit. I mean, I think it went up and kind of stayed. Same thing with the 50 day. So -2 went up to 0 and then down -1 side. It's pretty much right there. So that's good to see. Um, so that means that we may be looking at some more upside there. All right. I didn't see HP. Sure it's in there somewhere. There we go. HPQ. Yeah. I forget the letter sometimes. So I used to call it HP. All right, -5 up to 1, and then way up to 22. That's how we got that's how we got called out. -2, -5, up 13. So yeah, just a big jump, which doesn't make a whole lot of sense looking at the numbers, especially when you see this move down in November. Sorry, so that's it. Oh, I want to take a look here because this has changed over the last couple months. So let's look best performing portfolio over or since June 2018. So that must be the purchase date as well for these stocks. It's June 2018. So the best performing portfolio has been the down moves. So going back, even though more recently up moves has performed better since June of 2018. That's been, almost 4 years. The down moves portfolio has performed the best with down standard deviation coming into a very close second. Let's take a look at the rolling 12 months. Okay, so this is basically January to December. We see up moves, of course, performing better. And then what's really important though here is that we have these beta portfolios that are really coming up. So much so that if everything continues the way it's been going, we can see these beta portfolios actually beat out up moves. And again, that just goes back to where the money is moving. When there's a lot of activity, money is going to some of those up move companies, but they're also moving into a lot of the beta plays. And we see down moves, which is just coming down. I mean, 18 versus 27 is a big jump. Not so big when you're talking about 19 and 20, but that 27, I mean, you just can't beat it. Let's take a quick look at um, the beta alpha, beta return alpha. Let's look at the beta alpha. Let's see what's in there. Beta alpha is a real contradiction, but it makes sense, right? So beta are the companies that perform better when the rest of the market is going down, right? So when the market is losing money, these companies perform the best out of all of the companies. They tend to move up. And then alpha is just the opposite of that. When the economy, or I'm sorry, when the rest of the market is moving up, these companies actually perform better, right? And so literally the score is just half, 50% beta score, 50% alpha score, and that's how you get your beta alpha score. And so these are the companies in that portfolio. And as we talked about before, AEM somehow makes it into all of these portfolios, but has not performed well at all. So I feel really good about not being in AEM, even though it is sector MVP. And then Intel, I think we said the same thing, whereas again, it's in a lot of well-performing portfolios, but just not has performed very well as of late. MPW, of course, is where we are. FE, we saw that has a really great return in that utility sector. Best Buy, we're seeing again. OKE, I don't know a lot about that company, but of course it is energy. And then Blackstone again shows up along with Paychex, SYY, Merck. Tullis we talked about, and so yeah, I mean I can see again how this is happening, right? I mean Blackstone, I can't say enough good things about Blackstone. The other cool thing about Blackstone is that as these interest rates rise, I believe Blackstone will outperform the rest of the market just because they're so good at bringing in money and then investing that money for profit. And I think that's going to be um, easy for them to do in the current environment. The only thing that has ever really worried me about Blackstone is their investments in real estate. But as we saw, the real estate sector is doing really well right now, and so again, I don't expect Blackstone to move down much at all. Same thing about paychecks. And so we're just seeing some of these companies just over and over and over again in the better performing portfolios. So again, just goes to, kind of where the market is headed and what companies are performing best right now.